please, the floor is yours again for next 15 minutes.
Thank you very much, Oli. So we are the last presenters of the day. So we are very grateful to all the people that are still connected and listening to this presentation. We'll try to be brief and to the point, and to leave much discussion time. So I will present briefly the context of this paper. So if we go on the first slide. So this paper was born thanks to our participation to the EBA work within the Sustainable Finance Network that is trying to investigating the introduction of ESG risk in the prudential framework, and we participating in the team that is investigating the risk differential regarding ESG risk in bank portfolios, and we were looking at more precisely mortgages. And so we were looking at the specific assets, and we realized, so we saw that price valuations has an impact on the risk profile through the two factors, so through the LTV and LGD factors. And we realized that the industry is more especially using the price differential that is coming from the energy efficiency rating to design a specific asset class, such as energy efficient mortgages. So we decided to investigate a bit more about what we so-called then the green premium in the European residential market. And so we can go to the next slide. And for that, starting with the literature review, we realized that there were a lot of literature on this topic. We realized that there were more than over 100 papers and over 200 estimation of this green property value already, covering a variety of market, from commercial to residential and various geographical region. And so we decided that a tool that is called the Metaanalysis could be very useful in order to use a synthesized estimate for this green value, and that could help prudential authority to have a more reliable estimate. And so that's why we decided to perform a meta-analysis on the investigation of the green premium. So here, before giving the floor to Numa, who will describe a bit more the meta-analysis, I would like to say that this work and this research was complementary to the EBA work within the Sustainable Finance Network, but it's most of it's independent, and that all the results and the discussions that are coming from this paper are reflecting the views of the authors only. And with that, I give the floor to you, Numa.
Apologies, I'll start again. Sorry, yeah. So the work presented here is an extension of two previous meta-analytical works on the green premium. And by extension, we mean that we collected relevant papers on that topic from two previous meta-analyses, and then we look for more recent ones. So these additions are not to be made without reporting a certain set of informations, which are the research question and the keywords and the databases queried, so that our work is more traceable. So for instance, and for transparency purposes, on the second bullet point on this slide, you can see that we queried Google Scholar and Science Direct and asked for papers linked to EPC green premium, but also EPC hedonic premium. And so our objective is to retrieve a certain set of information from the papers as well, which in this case, in the case of a meta-analysis, are called the effect sizes and also their standard errors. This will allow us to compute what we are aiming for, which is the summary effect size. So the models we've focused on are hedonic models as defined by Rosen in 1974. And in our case, it was defined as the logarithm of the price expressed as a function of energy efficiency and a vector of control variables x. So what we are doing is that we are pooling the betas to estimate the summary effect size. And in parallel, we look for the standard error. And I must say, this was the most cumbersome part of the analysis, as not reporting standard errors can sometimes be a common practice for some authors. But fortunately, there are ways to retrieve such an information if the authors do provide, for instance, the statistics or the confidence interval for each estimate. So for instance, standard error is a ratio of the estimate over the t-statistics. So if those two metrics were given, the standard error could be retrieved. But if none of them was made available, then the study simply had to be discarded. And our estimation then relied on less information. So more precisely, we started with 167 estimates for the European continent, and that number fell down to 112 once we removed all the estimates that were made not usable. And one of the reasons for that is that the standard error was neither reported nor retrievable. And after trimming the database, we ended up with 8 studies focusing on commercial buildings, and we will then work with 104 residential estimates of a green premium in Europe. And then we subsampled for the market types, which could be either rental or sales contract. And we ended up with 84 estimates for sales contract. And from those 84, we discarded then, we suspected that some of them could introduce a degree of double counting. More specifically, we're talking about values that are estimated using subsamples of a study full sample. And so in such a case, we would only retain the general estimate from the overall sample and not the one from the subsamples. And so that happened especially with one of our sources, one of the studies that we reporting many estimates, and it's from Notaire de France. So the baseline methodology can be quickly summarized as follows. So your database is characterized by a certain degree of heterogeneity, here measured using the I-squared metrics, which was developed by Higgins and Thompson in 2002. And 2 types of heterogeneity are usually defined as variation in reported estimates can either derive from sampling error or more varying methodological designs. So this I-squared measure was selected as it's considered to be more reliable than others, such as the Cochrane Q-stat. And then starting from there, 2 modeling strategies can now be envisioned, fixed effect and random effect modeling, and both rely on 2 different assumptions directly linked to the level of heterogeneity in the metabase. So the fixed effect model relies on the assumption that the total variability in the individual studies estimate is solely the outcome of sampling error, and then the random effect model relies on the assumption that total variability is not solely attributable to sampling error. So in our case, the fixed effect assumption is a bit too strong, so we allow variability in the estimates or in the effect sizes to be caused by something else than sampling error. So the random model assumes not one value for the underlying true effect, but the random model assumes distribution, an underlying distribution of effect sizes. But still, the computation of the summary effect size still relies on an inverse variance weighted average procedure, but which now splits variance between within study term and a between study term. So our overall premium is rather high, and due to a high degree of heterogeneity, as you can see, it was impossible to even consider the fixed effect model. And so our green premium is estimated at 8.79 with a confidence interval at 7.8 and 9.7, which is high. So the goal is now to investigate what the drivers of such an heterogeneity are in our research. So apologies for the very small numbers and very small characters, but this is a kind of graph the kind of plot you end up with in the meta-analysis. So giving you for each study in the sample all the estimates, all the effect sizes, and their standard error. So this allows you to visualize more easily what's going on in the sample and which are the most precise estimates and which are the less precise estimates, and also how close to each other they are. So what we do then is we proceed to meta-regression, and to do that, prior to that, what we did was to sample filter the metabase, so to make sure that we get a nice, normally distributed metabase. And since we're dealing with a high degree of heterogeneity, and since that heterogeneity is likely to come from varying methodological designs, we looked at the EPC variables that was used in the Rosen type models. So what we do is we study how this variable, the EPC variable, is treated in each Rosen regression, so to say. So yes, we expected that with different treatments of the EPC variables will come different levels of premium. So we have three hypotheses, and so the first one deal with the first two ones. Sorry, deal with the treatment of the EPC variables, and the third one is the first step into publication bias analysis. However, the equation displayed here do not entirely reflect our work on the meta-regression, and as the objective is to introduce a set of moderators to control for common parameters among the studies in the metabase. As you can see here, we expect in the first equation, in the equation number 3, sorry, we expect beta 1 to be positive. The greater the distance to the reference EPC band, the higher the premium. In the other second hypothesis, we also expect beta 1 to be positive, and the more EPC categories you pull, the higher the premium. And regarding this third hypothesis, we expect a negative relationship between the premium and the publication. So it's a binary variables regarding whether the papers we drew the estimate from is published in a scientific review, or it's whether it's not. So here I quickly show you the set of moderators we chose. So this is basically what you could call metadata around what surrounds the estimate in each individual study. And so quickly starting from the top in this vector, what we have is whether or not the study controls for compares EPC rated A buildings to non-labeled buildings, whether then the regression controls for the building types, the neighborhood features, the building's location, the market type, or the construction dates. And of course, we determined which were relevant using an F-test. So meta-regression tables are available in the appendix of the paper. However, they are deemed less reliable than the computation of a robust meta-regression estimates, and this is justified by the fact that some authors disclosed gave multiple estimates per study. So what we noticed, and I'm trying to be quick here, the coefficients are not as significant as they were in the traditional regression, once we acknowledge that some estimates come from the same studies. And so what we noticed mainly was that there is a drop in significance. So as you can see, we ended up finding that the distance to EPC reference band was significant, and what that means is that you get a higher premium if you choose to use a lower reference band in your EPC treatment variable. So, for instance, if you compare A-rated buildings to, let's say, G-rated buildings, you're more likely to come up with a much higher premium. So this is something to consider when reading about green premium on the real estate market. And so what the bottom line is that, of course, we have this drop, but we keep a similar magnitude. And so just to conclude, further works should, of course, focus on updating the database, and we will also need to ask authors of already published paper to disclose their standard errors. I've seen that being done in previous meta-analysis, and but it's really time-consuming, and you don't really, well, you're not supposed to expect much success, especially if the paper is really old. What we would like to do as well is to investigate that sudden significance in the non-labeled coefficient, because it never was significant, but now computing with the robust meta-regression, it turned out to be significant. And then I leave the floor to Deborah again.
Thank you very much, Numa. So very quickly to wrap up and to give some flesh for discussions. So we think that our paper and this research is providing good insights for a synthetic estimation for green property values. And that could be very useful for prudential authority when they want to quantify and use such quantifications at EU level, and so that to at least identify and understand the heterogeneity that can be seen at the aggregation of several countries. So we have shown that we still have a positive and yet significant green property value that is in line with our sentiment that ESG risk are taking more and more impact on price differential, and that could be a good insight for the rest of the risk differential analysis at least on the mortgage segment. It is higher than the estimates performed in the previous meta-analysis and even in the earlier years estimation for green premium, which is also maybe in our sense a sign that data coverage and quality regarding energy performance certificates is also improving. But the other interesting result is that the meta-analysis has succeeded to show that the synthesized estimation is more conservative, a more conservative estimation that the industry could the industry or the non-academic papers could use. So that could be also an interesting result to have in mind. So we sure identified drawbacks and room for improvements for this kind of research. Aside for the heterogeneity and the significance power that Numa explained, we also would like to estimate the other side of the spectrum, meaning the potential price discount that can be shown at the least efficient segment. of the market, and so that most of the papers only investigate green premiums. So that should be something to consider for further research on that topic. And with that in mind, we dare to outline two policy recommendations on this point. Is that meta-analysis could be a very useful tool for prudential authorities to when they have a lot of literature on the topic to perform a synthetic estimation for EU level quantification. And the second one would be given the room for improvement on the data that we're having here, meaning the energy performance certificate rating, that any calibration of the prudential framework, if there is, should leave room for the evolution, for some evolution, at least for the classification, as we saw that the data qualification do play a role in the magnitude of the estimation that we found in our results.
Thank you. Thank you very much, Deborah and Numa. The discussant of this paper is Angel Berges. The floor is yours. I would kindly ask you to be relatively short, given that we are a little bit behind.
Okay,
apologies for that.
Thank you very much. Thank you. Okay. Okay, so let me. Okay, so this is an interesting paper from a methodological point of view, and I have I have no objections to it, but of a very limited validity regarding applicability to our prudential regulation. There is certainly a need to produce analytical and empirical research to support regulatory and supervisory decisions around the treatment of ESG, and especially of climate-related risk. There is a lot of evidence on wholesale markets and especially green bonds, but not so much on the retail market and mortgage. In this sense, the paper performs an ambitious exercise that is searching on a very wide amount of published papers through meta-analysis, and in this way it's a powerful tool. It's like a literature review, but helped with this type of statistical analysis. They cover over 160 papers, and with a rigorous filtering, they end up with 69 papers. The finding is not surprising at all. I mean, they get a significant effect in house prices due to high versus low energy efficiency, about 8.7%, which is quite. I mean, it's something that I would highly expect. It's highly heterogeneous across countries. More robust estimation when extremes of the efficient scale are used. It's somewhat surprising or anecdotal that published papers in scientific reviews display a smaller amount, maybe due to higher methodological rigor or statistical significance or some other reasons. Now, these results are statistically significant and quite relevant, but they fall really short of the policy questions that the authors propose around prudential regulation. In my opinion, absolute price or premium in an energy efficient house versus a non-energy efficient house has nothing to do with prudential regulation. It has nothing to do with with probability of default, which is in the end what prudential regulation should be pursuing. I mean, is it really the case that a premium or bond discount in house prices has an influence on the risk profile of a mortgagor? I don't think so. At most, it would be price dynamics. That is whether the premium is getting higher or lower. I mean, but absolute price has nothing to do. in this sense, it will be interesting in the empirical analysis they have performed to look at the temporal evolution, or at least to compare that premium with some fundamental reasons. For example, let me give you an example. Energy savings. An average, Bank of England estimates that an average 2 to 3 bedroom apartment saves on average about 800 to 1,000 pounds yearly. If you take the net present value of that, that may amount to about 5% of the pricing of the selling price of a house. So if the price differential of a energy efficient house is due to the energy savings, then I mean this has absolutely nothing to do with the probability of default or expected arrears. As a matter of fact, I wanted to propose the author, or to suggest a couple of papers that I have seen. One of them analyzing the US market and the other the UK market. One of them sponsored by the US Department of Housing and Development, performed by Keisa, Kershi and Tiam, and the other one looking at the UK, again, sponsored by Bank of England. In both of them, what they find is that controlling for all the specific characteristics of the borrower, like age, income, FICO score, etc., the probability of default of mortgages on an energy efficient house are significantly smaller than the probability of default on a non-energy efficient building. As a matter of fact, in the US estimate amounts to about 0.65%, and in the UK about 0.21%. In none of them, house price enters as a significant variable. House price by itself, it may enter as the denominator of the loan to value, or I found very interesting that in the US study, house price relative to zip code sales price enters with a significant negative effect. In other words, higher house price relative to the average house price of the neighborhood is a good indicator of better payment ability. So in this sense, again, I have no reason to consider that house price by itself makes any difference at all with prudential regulation. Now, after seeing these papers from the US or from the UK that demonstrate, well, one of them uses about 60,000 observations, and the other one, the one looking at the UK, about 1.5 million mortgages. So I think they are quite considerable. If we take this evidence as consistent, it may be used by banks to adjust their lending standards and even to apply some differential pricing. What I don't see the point at all is that prudential regulations should be modified in the sense of accommodating capital requirements to climate change. I mean, a recent paper by the BIS recognizes that, or a recent paper by the British Prudential Regulation Authority recognizes the same. As a matter of fact, they point out that incorporating the type of green supporting factor, we might be creating a green bubble, and therefore to cause a house premium that is much higher than the one expected, than the one explained by energy savings, or even by some government support, which I mean they might be as well able to consider. So in general, I mean it's a nice paper in terms of methodology and scope of the searching on the available published evidence, but in my opinion of little relevance in terms of prudential regulation.
Thank you very much, Angel, for being short and for your very clear comments and recommendations. I think this discussion just shows that the debate on the prudential treatment of environmental issues is lively. It's only actually just starting. So any research like this would be eventually extremely helpful and important contributing factors for our better understanding of what ultimately or not the prudential regulation of environmental issues should be. So thank you very much for that. And we have now come to the end of the academic part of our program.